Today's sideways market is proving to be a classic test of behavior for investors. It is easy to be a long-term investor when everything is going up, but time corrections like these bring in boredom, fatigue, and doubts. Why do we get so impatient with equities, and how can we use such quiet market phases to build wealth? To discuss all this and much more, in the next episode of Decode, we have Shyam with us here as always. Hi, Shyam. Uh, the first question that I'm going to ask is from a WhatsApp forward. I'm part of an investors group, and recently, in the last 2 3 days, there was a forward giving a list of typically large cap blue chip stocks, showing that A, B, C, D, E, F, a list of 20 30 stocks. Now, this stock has not given returns in the last 3 years, this one in the last 2.5, this one in the last 4.5, and so on and so forth. And the forward ended with this line: this is why timing is important. So I was just thinking about it. Now, usually when you see such phases in the market, you tend to tell people time in the market is more important than timing the market, and so on and so forth. So, hang on and wait. Now, but there are times when timing also becomes important. For example, at present, we are saying blue chips, it's a good time to invest and all. So, how do you distinguish between when you should look for timing and when you should, wait or let it go?
As an investor, you know how to judge valuations. Look at it from a valuation standpoint. When you look at it from a valuation standpoint, you are seeing that the best of private banks are at a price to book of 2. Usually, you say that they are the indicator of the economy. The reason we are not feeling great about these private banks has to do with the growth, their own transition post M&A, and factors specific to each bank. In one, it was a leadership transition. In another, it is a transition from a merger. In a third one, many of the subsidiaries are seeing a change in ownership, like a partner is going away and the bank is becoming the sole owner of a business. All these things are happening. And generally, these are entities which are heavily FI owned. And they are just going for the exit door. That is what is giving you this valuation. Similarly, the same thing is repeating in several blue chip companies across sectors. What I would look at now is, if I can buy this favorably, what would be my return over a 5-year period, not the next 1 year. Now at $105, should you be judging at this price of oil, what will be the next year's stock price of Asian Paints? Answer is no. Answer is no. You should be judging what will be the company after 4-5 years and making your bets now. Similarly, if you are looking at a telecom company, clearly you are going to see consumption of data grow, you are going to see cash flows grow, and you are going to see capex come down, which means that as the stock stays at the same valuation or becomes cheaper, it becomes more attractive. If you take pharmaceutical companies also, slowly they are trending towards the lower end of the valuation band. So when you are at the lower end of the valuation band across sectors, simply because of FII outflows and near-term uncertainty, you should take advantage of timing the market now. And then you should give time in the market. If you time now, you are able to buy at a favorable valuation. To buy at a favorable valuation, timing is necessary. If you say, no, I will get my timing even more fine-tuned, chances are you will miss it. That has been my experience. So when you see a valuation that is too good to be true, you leave some margin for error and start acting. You don't try to cut it too fine. So in that sense, when you see all these images, I ask myself, what is it that I thought would be a reasonable valuation for this kind of a business? And I find that many of these companies are actually either there or lower. I think that we are running away from VUCA as investors in India. We should deal with VUCA square on. Take it head on. And I think that you should do timing now.
Okay.
Maybe you don't put all your money in one go, but you keep timing over a period of time. So that even if you're wrong in the first instance, by the time you have done 3 or 4, you would have overall got your timing right.
Okay.
So, and then you must be ready to give time. That's one important thing that I think today everyone needs to understand. You need to do timing now, but you should give time. And I don't think that this scenario is forever. I'm sure that this will change. And when it changes, I think the entire perception will change.
No, that was another question that I had actually. A lot of post-COVID investors, they have entered the market in the last 2-3 years and they are not seeing anything great right now in their portfolios. So this is a question that all of them seem to be asking. Okay, I'm willing to give it time, but when do I see that time ending where you don't get any great returns, and when does that time period start where I will start seeing good returns, and at that point will what I get make up for what I lost?
I'll tell you my experience across multiple cycles when I didn't have returns for 2 years. The third year will also be like that. A part of the fourth year will also be like that. Then towards the end of the fourth year, you start seeing returns. Fifth year is good. Sixth year is even better. Seventh year is great. Eighth year looks too good to be true. And then towards the second half of the eighth year, things turn for the worse.
Okay.
This has been generally the playbook that I have seen multiple cycles. I'm not saying that this will be the thing this time also. But the lesson from this is that when you don't have returns for 2 years, you don't lose your patience. If I had lost my patience after 2 years, wherever I lost my patience, I have been punished. Because I would have given away the asset. I would have sold. And the guy who bought was a smarter guy. He outsmarted me wherever I lost my patience. Wherever I held my patience, I was able to outsmart the market. Now, my lesson from where I got outsmarted is that I had only one thing missing. The willingness to wait. Because 2 years had gone, I was willing to surrender my conviction. And that's why I failed in those instances. First cycle this happens a bit, right? But then slowly, cycle after cycle, you learn. And with every passing market cycle, you give more importance to waiting. Because you know that things will turn. The fundamental business, as long as it's solid, sound, and growing, you will have to give it time. So I think that after 2 years losing patience and saying that, oh, nothing has happened, why should I be in equity? I could have done something else. If I had put money in gold, or I could have gone to FD, oh, I could have invested in Korea, I could have invested in semiconductor. I think an investor can say, I could have done this every single day of his investment life till he dies. The question is, what are you doing now in the present? I think you have to get that right. This regret-driven life is not going to take an investor to a better place. I have learned this as an investor. I process all my mistakes, but I don't live in regret. The processing of the mistake is to make me better the next time. Now, if somebody has come to market post-COVID, first he has to accept that he had it too easy. That's how I view it as a investor who has experienced that phase. And when you had it too easy, you have to understand that the market will test you later. That's the experience. So today the market is going to test you. Accept that. Then life is sorted. You start behaving differently, and you are not restive or restless or uneasy or going to show a rush of blood in decision making. Whether you are managing your own money, or you're giving it to a mutual fund, or you're giving it to a portfolio manager, or to AIF, or whatever, or even you run a family office with multiple people who are running it, it doesn't matter. It's the same asset class you are being. It's the same quality of business that you are investing in, more or less. Everyone is trying to invest in better businesses. So I think that today behavior is going to be the differentiator. That will be the differentiator. Unfortunately, as you rightly said, a lot of people who have come post-COVID are not coping with the challenge of
Right.
low returns or you know some kind of a zero return phase well. And those who are actually having negative return, no, by doing it on their own, I find that they are showing more patience because they are hoping that their decision will come right
Okay.
someday. But the others who are under assisted investing and stuff like that are being very restless, even though they are not in such a bad shape. So I think today behavior is going to be the biggest differentiator in this market, because I think that this is going to test investors for a longer period of time. It's quite clear. Now, suppose, as I said, in the beginning of this conversation, that the third year is not having return. A part of the fourth year is also testing, and then the second half of the fourth year things turn. You got 18 more months of waiting.
Uncertainty.
Suppose I'm wrong and it takes even longer, then it's even worse. Like you've done 2 years, you need to do 2 more years. My experience from what I did in those past cycles, if I can tell you, I didn't flinch. I kept on investing. I kept focusing what I can do better in my investing, where I can improve my investing, where my portfolio needed attention and intervention, very specific actions. And this in every market cycle, we have to learn and get better. There's no escape from this. Whether you're doing it on your own or through somebody else, this is a continuous thing that needs to be done. We are in a phase where if you don't do this, it's going to create double the regret that you have today. Today's regret is you don't have results. But tomorrow's regret, if you don't do this in the next 1 or 2 years, can be that you completely lost a cycle.
Understood. But in the whole process, sometimes exit decisions have to be taken. There is no escaping exit decisions for various reasons. Now, how do you reason out a reasonable exit decision from an unreasonable one where waiting could have served your purpose?
See, I think let's look at it from an individual investor standpoint. Suppose I am investing on my own. I'll have a circle of peers with whom I reason out exits before I do it. Add one layer of security for your decision making. Suppose you are with an advisor, you can get a second opinion from another advisor. That is very simple. You can get a second opinion from somebody who you think is an investor you respect, because he has got investment experience. You can go to the very advisor and have a conversation to understand the mindset and the reasoning better, so that maybe if you have a confidence deficit, bridge it. You need to make the effort. If you see what I have told you, in everything there has to be an outreach. Investor has to reach out to the right people to get the right guidance at this point in time. Just keeping to yourself and forming judgments which are based on just this bottom line of returns is what will lead to mistakes. I think you must be very balanced in taking your understanding higher and forming your judgments in a very well-reasoned way. I think that's the only thing that can be done now. And that's the only thing you can do in every market cycle. It's been no different. I see a lot of people get very agitated. Some people will blame the government, some people may blame a minister, some people blame a corporate group, some people blame television, some people blame influencer. But I think finally the buck stops with the investor. That's my simple reasoning. It stops with me as an investor. I need to take ownership. Similarly, everyone needs to take ownership. And if you're taking assistance, how does this ownership manifest? You take the right assistance that you need at every point in time. Simple as that.
Oh, this is a very investor psychology kind of a question. So the other day I was talking to my dad, and he has a friend or a cousin who's largely into real estate business, and it considers real estate as an investment and all that. So he was telling me, this person tried his hand in mutual fund investing, and he tells me that he was very unlucky with mutual fund investments, and it has actually eroded his capital. So there are a lot of investors who always show this classic willingness to wait when it comes to a real estate investment. Not necessarily an apartment, could be a land predominantly. And there are investors who are also willing to wait when they put in money in gold, because they always believe gold will never let you down and it will always go up. Why do even established investors, not only new investors, why do people really become so impatient when it comes to equity investing? Why do they want to see returns immediately?
I think these behavioral biases come from one's past experience. What is the family construct on investment? Assume that you are in a family where your father did mutual fund or equity for 20, 30 years. Then you will not have this. You would have seen it in your house. You would have seen dividend warrants come every year during the second and the third quarters
Yeah.
of the year, and you would have gone and deposited it in some bank in those days.
Yeah.
Nowadays, you would probably help your parents with maybe helping with a annual return or something like that. You will have conversation, people talking, so you understand that dividend is a source of income. You will understand how in some years capital gains will not be there. Some years you will have very high
Yeah.
capital gain. You will
Yes.
understand lumpiness. And if you are observant, you would have compared it with land and gold also. So my experience is land is also almost a 8-10 year cycle, right?
Yeah.
2004, land was at a bottom.
Yeah.
Let me tell you, in the area that we are in, right behind us, it's one of the very popular residential suburbs of Chennai.
Yeah.
1996 peak price was almost 2004 bottom price for one ground of land. Now, how many people who are this chronic land bulls understand this? You leave this. You go to Weimar or ECR, same problem. 2008, 9 or something like that was a peak.
Yeah.
Post tsunami, there was a massive rally. Okay. After 6-7 years, almost same price or even 40% lower land was available in some pockets. ECR became cheaper than OMR, which is ridiculous because you're closer to the sea, it's a better quality land and stuff like that. So I think this irrationality keeps happening in cycles in every asset class. It happens in real estate. It's happened in gold. People have forgotten. Indians have forgotten that, every year they made 3% of return in gold due to the currency. Nothing else. So you are actually building a muscle memory on something which is not based on the actual return of that asset class on a constant currency basis. So I think that these biases come from how we grow up, what we observe, what our family believes in, what our social circle believes in, all these things. I don't want to, make this a case of knowledge and ignorance. I think it's upbringing and it's experience. So I think that, again, if I may stick my neck out and say, people are going to experience the same thing they experienced in gold and silver in the last cycle, which was a lot of pain. And in real estate also. Real estate, particularly in the big cities like Mumbai and Delhi, where government land is there to be monetized, is going to be very painful for the next decade. Relatively, I think growth will put equity in a much better place.
Okay.
Because you do have economic growth with all the right interventions in every crisis. This growth comes back to what you think is very desirable. So when this comes, I think that equity will actually be in a better place. So whenever equity is out of favor, you don't compare it with the other asset class and say, I wish I had been there. You use equity's strength.
Yeah.
That is what I have done all my life. I am not against the other asset classes because I have invested in them, but not in the way which doesn't serve my return objectives in that asset class. It's not blind investing, saying that, oh, gold will not go bad, land is anyway, any day the value will be there. All these statements are all, I think, biases rather than good reasoning.
Understand. So Shyam, you don two hats now. One as an investment manager and one as an individual investor. So in such market phases or in any market conditions, so would the decisions you take be different as an investment manager and as an individual investor? Or, because you're ultimately handling other people's money,
Correct.
and their ideas and perceptions will be different from, or their risk appetites may be very different from what you have for yourself. So, how would you, look at today's market situation wearing each of these hats?
See, as an individual investor today, um, I'm not so active, in, in stocks as I used to be before I started my PMS, for example. Um, Personally, I don't, buy too many stocks or anything like. It's more very small experiments that I do relative to what I used to do in the past. As a manager, today I follow all the principles that I have followed as an investor. Whatever I learned over those previous 20 years, between 1990 and 2019, it's nearly 29 years. After that only I became a portfolio
manager.
So all those principles I try to apply in our investing, especially what worked. And so there's not much of dissonance in my thought process. When I put money in smaller companies, very small companies, it's in the private space where the gestation is 10 years. It's a 10-year gestation in my mind.
Okay.
Company may do 5, 6, 7 years if I'm lucky. But broadly, it's a 10-year gestation.
Okay.
So I don't have much to, become anxious or anything like that. Actually, that has also helped me as an investor and as a manager. Because when you're working with 10-year gestation, all your big new ideas, you become very stable and you start looking at what you need to look for a 10-year horizon. So that is also helping me professionally. So I'm not looking at the next quarter and the usual stuff. It doesn't work.
Yeah.
It's not going to work. It's hugely competitive environment. You need to think beyond the immediate and look beyond the obvious. So I think these are things which I have, I would say, accidentally landed because I started investing in private markets in 2016-17. Momentum picked up after 2019, and last 5-6 years has been quite active. So the more I have done that, the more patient and long-term oriented my professional investing is also becoming.
Okay.
It's taught me, but I didn't do it with this intention. But that thought process has grown on me.
Okay.
So it's all the same. What I learned as an investor went into what I did as an investment manager. It's a continuous process.
Okay.
Those learnings help here.
Okay. Shyam, so this market phase is somewhat boring. Nothing much is happening, and there are daily movements up, down, and predominantly sideways. So people tend to kind of get impatient and do some mistakes. So maybe today you're much wiser as an investor, but from your early years or from your middle years, do you remember making mistakes, particularly in such boring phases?
A lot of mistakes will happen in these boring phases. When you don't have returns, you don't have capital to buy new ideas. So you will keep on looking where to find money to buy new ideas. And I told you that good decisions take 8-10 years sometimes to come to their full potential. So 2-3 years later, like if you look at this 2 years, suppose you started investing in a stock in 24, in 26 it's not doing great. You start thinking, why should I keep my money here? Can I put my money elsewhere? If I put my money there, can I grow faster? All these thoughts will come. It's normal. When you get these thoughts, what you end up doing is sometimes you sell a good company which you should not sell to buy a mediocre company which you need not buy.
Okay.
Okay, the desire and the need for action can do this. And when your portfolio itself is not performing well, you feel that changing it will make it better. So you will make changes for the sake of making changes. These are things that later tell you, when you look at the old portfolio and the new portfolio, the old portfolio would have been better than the new portfolio. This has happened in 1 or 2 cycles for me. So I realized that all the action that I actually did was a waste of time. It's activity for the sake of activity. Which is why when I became a professional manager, I decided to keep my trading, that is churn minimum, the generation of short-term capital gain, to the barest minimum possible. I don't like to sell within the same year. I don't buy something which needs to be traded swiftly,
Mm.
stuff like that.
Mm.
I don't chase momentum in a way which probably a lot of managers do,
Mm.
because I feel that that doesn't help me
Mm.
sustainably do good investing.
Mm.
Because you are always chasing momentum means your orientation is very short term.
True.
The
Mm.
thought process is short term. You're saying what will work in the next 2 quarters.
Yeah.
Whereas I want to look at what works in 3 years or 5 years,
Mm.
which will probably give you compounding at a scale
Mm.
which this 2 quarter, 3 quarter approach
Mm.
may not give. That's what I learned from the mistakes.
Mm.
But the mistakes basically happen because you feel pressured for capital or for returns.
Yeah.
And then you make changes to the portfolio.
Yeah.
Then the shares you sell turn out to be far superior to the shares you buy.
Mm.
And the time you invested in those shares which you sold go to waste, because you would have invested 2-3 years.
Yeah.
And then 2-3 years later, it will take off. What I learned from some stocks is that I waited 4 years,
Mm.
I made 2-3x and sold.
Mm.
Subsequently, the stock went nowhere. And then another 3 years later, it was 50% up from what I had sold.
Mm.
From that level, it went up crazy. It went up 50 times.
Mm. Yeah.
So again, when I try to get in after those 3 years,
Yeah.
I don't get the opportunity to
Correct.
get in.
Yeah.
So if I just idled and done nothing,
Mm.
I'll probably be much better off.
Mm.
So this concept of waiting long
Mm.
in some businesses is something that my mistakes keep on trying to teach me.
Yeah.
I don't know whether I have learned it too well, but I'm not doing too badly either.
Mm.
So it's a process of evolution. You
Mm.
become better
Yeah.
with every passing cycle. Your hall of shame keeps reminding you that you need to learn from those mistakes
Yeah.
and grow out of them.
Yeah.
Basically, you grow out of your mistake.
Mm. No, I think, but most times we end up repeating the mistakes, thinking this time it will be different.
That
so,
I don't like.
Yeah.
And thankfully, I have not done that.
Yeah.
New mistakes do happen,
Yeah.
but thankfully, we have not done the same mistakes.
Mm.
Most of the time, will not happen. But I think the selling better stock and buying mediocre stock is something that's the biggest risk.
Mm.
Okay,
Okay.
that's the mistake that scares me,
Okay.
and that's something that I keep on thinking about
Okay.
and hoping that it doesn't happen the next time.
Mm.
And
Okay.
that's a fear you live with as an investor,
Mm.
and that's a mistake that keeps recurring. Also, let me be honest about it. So that is the thing that I keep thinking about. The names don't matter actually.
Mm.
You may think that I have not given any names of companies. There's so many, it doesn't matter. The names don't matter. But the principle of where you go wrong and the awareness that this is where you go wrong is what should try to make you a better person as an investor.
Mm. Okay.
Whether you're an individual investor or professional hardly matters. It's the same mind that works.
Yeah.
And you have whatever you learned in investing personally, you tend to take it into your professional work because it helps enormously.
Yeah.
If you're a decent investor,
Yeah.
if you want to be a decent manager, you have to take all your learnings as an individual investor into what you do for others and add a layer of security for the investor. So I think it's the same thing. There's not much difference. And the mistakes do happen as managers also. So we create products where we don't churn too much. That's how we keep ourselves in check.
Okay.
Naturally, if you don't do trading and short-term decision making to bump up your returns, then your whole thought process calms down and tries to do better long-term compounding. So superior compounding is what you're trying to do. Then your whole orientation, what product, what is the philosophy, how you run the process, how you run your decision making, and how you make changes. All this align. And where does improvement come from all this? From the mistakes and the learnings.
Understand. Be patient and give time for your conviction to play out. Churn if needed with an eye on valuation. And become wiser in every market cycle by learning from past mistakes are some of the key takeaways from this conversation. Hope you enjoyed watching this episode of Decode. See you in the next.